Hello friends, welcome to Easy Learning Economics. This is Dr. Cowell, PhD in Economics. I hope that you have been enjoying Easy Learning Economics and learning more. Today we are with new concept of types of cost, their shares, properties and classification of cost, and how to classify cost on the basis of payment mode in the short run and long run period, along with long run cost and long run average cost curve, expansion path and learning curve. So this is very important topic. In this topic we discuss that what is cost, what is short run and long run period, and what are the fixed input and variable inputs, and what is fixed cost, what is variable cost and their properties, what is total cost, what is average cost, what is average variable cost, what is average fixed cost, what is marginal cost, how to classify cost on the basis of payment, and further we learn that what is explicit cost, what is implicit cost, what is accounting cost, what is economic cost, what is incremental cost, what is sunk cost, what is long run total cost curve, and what is expansion path, and what is long run average cost curve, and what is learning curve. So this is the big contents for today lecture. So be ready to learn each and everything in detail with me. So I hope that you have subscribed my channel. So here, this is the good news for you, that you can get my notes on the same video which I will upload for you. Also you will get my notes on my website easylearningeconomics.blogspot.com. so link is given in description box, and you will not only get the notes on this topic but also all the economic related topics which will upload soon you will get. So must subscribe and visit my channel Easy Learning Economics, because Easy Learning Economics has made economic easy for you. And so please subscribe my channel to learn more with me. So we are going to start with cost, that what is cost and how can we define a cost. So cost are the resources used to produce a product. It is expressed in monetary terms. So how can we define a cost? So the cost is the amount incurred by the entrepreneur to produce something during production process. What is the difference between short run period and long run period, and how fixed inputs and variable inputs we can define. So here we will learn that short run. So the short run, it means the time frame in which at least one of the inputs factors of production is fixed but the other inputs are varied. The short run is a period during which some of the inputs remain fixed. So the firm has not sufficient time to shift from one place to another place or to install a new machinery or plant, but firm can bring the changes in the variable factors, keeping the fixed cost becomes fixed. So how long run can we define? The long run is a time frame in which all inputs are variable. So in the long run all costs are variable. So what is fixed input? We can define the fixed input as an input in which the quantity does not change according to output. For example, machinery remain fixed, land remain fixed, building, tools, equipment remain fixed, whatever the level of output. So these are the fixed inputs which remain fixed during the short run. So what are the variable input? Variable input means an input in which the quantity changes accordingly to the output. For example, raw material, transportation, communication and sales commission, etc. So these are very important to learn before the cost, because we must know the short run and long run difference and fixed input and variable input. So here we are going to start the cost. As we know that all costs are variable in the long run, so we define cost initially here on the basis of the short run. What is fixed cost? How can we define the fixed cost? Fixed cost remain fixed regardless of output. So whatever the level of output, the cost remains same, like the rent of the factory, insurance expenses, property tax, interest paid on the borrowed capital, salaries of permanent employees that remain fixed. So we can define the fixed cost as the total obligation of firms for all fixed inputs are called total fixed cost. So they don't vary with output level. So fixed cost does not influence the marginal cost in economic decision. So here we can analyze the shape of fixed cost. So fixed costs remain fixed whatever the level of output. If output increases, that the cost remains fixed. For example, if there is a cost that is only 10,000, that remain fixed, that is the rent which the company is going to pay, that remain at various level of output. Whatever the firm is producing, 1,000, 10,000 or 5,000 units, the cost remain fixed. It means the fixed cost remain fixed whatever the level of output. So what is variable cost? Variable cost varies with the level of output. You can see here in the graph, as we increase the output, the cost goes up. As we increase the output, cost goes up because the raw material the firm will increase, the factory overheads the firm will increase, the electricity consumption will increase. So all the costs which increase with the output level is the variable cost. So how can we define variable cost? That the total obligation of firms for all variable inputs are called total variable cost. So variable costs change with every unit of production, like purchase of raw material, wages, sale commission, electricity and factory overheads. Fuel consumption will rise with the increase in the level of output. The variable cost increases with a decreasing rate because of the increasing return, whereas here the variable cost increases with the increasing rate because of the diminishing returns. What is the difference between the fixed cost and variable cost? We can say that the fixed cost means the cost that don't change in relations to production volume, whereas the variable cost vary or changes in relations to the production volume. The fixed costs are time related as they remain constant for a period of time, whereas variable costs are volume related. When production increases or decreases, the total fixed cost stay the same, whereas the total variable cost increases or decreases with increase in production, whereas decreases with decrease in production. Examples of the fixed cost are the rent, depreciation, insurance and the salaries of permanent employees, whereas the variable cost, the examples include the raw material, sugar, egg and the direct labor, wages of part-time staff. What is total cost? Total cost is combination of both the fixed and variable cost. It represents the cost of production of all units. So we can express the total cost is equal to fixed cost plus variable cost, or we may define the total cost as average cost into output. So you can see here that the total cost has the same slope as the total variable cost rises over time. Also the total cost rises over the time. So it means the total cost curve has the same slope as the total variable cost. So what is the average cost? Average cost or total average cost is the unit cost of producing a product at given level of output. So average cost is the per unit cost. That the average total cost is equal to total cost divided by total quantity. So average total cost first falls, then rises and is U-shaped. This average cost first falls, then starts to rise and it becomes U-shaped like this. It is equal to the slope of the ray from the origin to the total cost curve. What is average variable cost? Average variable cost is the per unit variable cost at the different level of output. Once we use the average, it means the per unit. So the average variable cost is equal to total variable cost divided by the total quantity. So the average variable cost is equal to average total cost minus average fixed cost. It is the slope of the ray from the origin to the total variable cost curve. average variable cost is U-shaped. It follows average variable cost first falls, then reaches a minimum and then rises. You can see here the average variable cost first falls, then reaches a minimum and then rises. So this is the property of average variable cost. What is the average fixed cost? Average fixed cost is the per unit fixed cost at the different level of output. Average fixed cost can be calculated as total fixed cost divided by the total quantity, or in other way we may calculate the average fixed cost. The average fixed cost is equal to average total cost minus average variable cost. It declines continually as output rises, as the given total fixed costs are spread over more and more units of output. The vertical distance between average total cost and average variable cost equals the average fixed cost. That's why a separate average fixed cost curve is not drawn. Average fixed cost continually decreases. What is marginal cost? Once remember that whenever we use the word marginal, it means additional. Whatever, when we use the marginal cost, marginal benefit, marginal revenue or marginal profit, it means the additional. Remember that the marginal means additional and it shows the change. So marginal cost, it means this is the change in total cost or change in total variable cost for 1 unit change in output. Marginal cost is equal to change in total cost divided by change in quantity. So the change in total cost can be equals to the change in total variable cost divided by change in quantity, whereas the change in total variable cost, we may write it as that the wage rate multiplied by the change in labor. Marginal productivity of labor, it equal to the change in Q over change in L, so that the wage rate over marginal productivity of labor. Marginal cost first falls because the marginal productivity of labor first rises, reaches a maximum and then falls. As a result, the marginal cost rises and is U-shaped. It is equal to the slope of total cost or total variable cost curve. So you can see here the marginal cost first falls and here it reaches a maximum, then starts to rise and is also U-shaped. This is U-shaped and it is equal to the slope of total cost curve. And marginal cost curve reaches a minimum before the average variable cost and average total cost curve intersect. This is the point where marginal cost reaches a minimum before the average variable cost and average total cost curve intersect from below at their lowest points. So how can we classify cost on the basis of payment? Explicit cost. So what is explicit cost? Explicit cost refers to the actual expenditure of the firm to hire, rent or purchase the inputs it requires in production. It is also called accounting cost. That the explicit costs are used to calculate the profit. Explicit cost allows for long-term strategic planning. What is implicit cost? Implicit cost refers to the value of inputs owned and used by the company or the firm in its own production activity. We may define implicit cost as an income a company foregoes when it chooses to do or not to do something. For example, Gills offered to pay $10,000 per year rent for the field XYZ, means the field implicit cost $10,000 per year. It means the company does not make any direct payment in case of implicit cost, whereas in case of explicit cost, the company makes direct payment. So what is accounting cost? Accounting cost refer only the firm actual expenditure or explicit cost incurred for the purchased or rented inputs. It is measured only in monetary terms. This cost is paid out from your pocket. What is economic cost? So the economic cost refers to both explicit and implicit cost. So economic cost can be expressed as accounting cost or explicit cost. plus implicit cost or opportunity cost. What is incremental cost? Before to learn about incremental cost, here we would like to learn here that what is incremental principle. Incremental rule or principles gives an idea to increase the production not only with one more product, it could be any quantity till the profit exists. According to this principle, profit can be existed either by increasing sales or total revenues or by decreasing total cost. So here, how can we define the incremental cost? Incremental cost refers to change in total cost from particular management decisions like introduction of new product line, undertaking of new advertisement campaign, or we may calculate the incremental cost as that the incremental cost is equal to incremental financing cost divided by the incremental funds borrowed. So this is the formula we can use to calculate the incremental cost. Here you can see the shape of the incremental cost. So what is sunk cost? Cost means the cost that have already been incurred by past actions. They can't be recovered. They are not relevant to future decisions. The examples of sunk cost, it means if $400 is spent last year to replace a water pump, so it is a sunk cost because once it is incurred we can't recover. For example, the $2 million spent 5 years ago on new manufacturing plant, or $1 million spent on research and development 2 years ago. So sunk cost, we simply define that when what is done can't be undone. So it means we can define the sunk cost in easy way that the cost that are not affected by the decision are irrelevant and are called sunk cost. So what is long run total cost curve? The long run total cost curve is derived from the firm's expansion path, which shows the minimum long run total cost of various level of output. When the output increases OQ1 to OQ2, the minimum long run average cost is there. So this is the average cost. So what is expansion path and what does expansion path shows? This is the expansion path. This expansion path shows and connect the optimal input combinations to produce the various level of output. At the points of tangency between isoquant and isocost line, that is called least cost combination. So the slope of isoquant means that the marginal rate of technical substitution. We discussed in detail the marginal rate of technical substitution. If you have not watched my video on the marginal rate of substitution, so you must go through my channel and search for the video marginal rate of substitution. How the marginal rate of substitution is totally different from the marginal rate of technical substitution. So here it means the slope of isoquant, the marginal rate of technical substitution is equal to the slope of the isocost line. Here optimal input combination is decided where the marginal productivity of labor over wage rate of the labor is equal to the marginal productivity of capital over the rental price of capital. So this is the point where the optimal input combination is C. What is long run average cost curve? This is the long run average cost curve. The U shape of long run average cost curve is based on the assumption of economies of scale. It means the output grows proportionately faster than inputs. Long run average cost curve shows the lowest cost of producing each level of output. When the firm can build the most appropriate plant to produce each level of output. So as the number of plants that the firm can build in the long run increases, the long run average cost curve approaches to smooth curve. Thus, the long run average cost curve is tangent or enveloped to the short run average cost curve. Here you can see the long run average cost curve is enveloped to the short run average cost curve and shows the minimum average cost of producing various level of output. If the firm plans to produce, let's suppose 1,000 units, so the minimum cost will be like this. And if the firm plans to produce at this short run average cost curve 20,000 units, the minimum cost will be between this. So likewise, what is the learning curve? How can we define the learning curve? This is the learning curve. The learning curve shows the unit cost is lower the greater the cumulative output of country industry to date. A country that has extensive experience in an industry, for example ale, may have a lower unit cost than a country with little or no experience, even if that second country learning curve is ale star is lower, for example, because of the lower wages, as you see in the diagram. So how can we define the learning curve? So we may say that the learning curve shows the decline in the average input cost of production with rising cumulative total output over time, because managers, workers become more efficient as they gain production experience. So average cost declines at a decreasing rate, so that the learning curve is convex to the origin. This was all about the cost and its classification, in which we discussed each and everything. So please let me know your feedback or any future request in comment box. If you like this video, please subscribe my channel and share with others. Thanks for watching. If you want to get notes on this topic or any other related economic topics, you must visit my blog, and blog address or my website address is given in description box. Thank you for watching.